Hi, so today we are going to see ICICA Foundation, Paper 1 Principles and Practices of Accounting, Chapter 1 Theoretical Framework, Unit 1 Meaning and Scope of Accounting. So, first, what is accounting? In 1961, Committee on Terminology, which was set up by the American Institute of Certified Public Accountants, gave a following definition. Accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are, in part at least, of a financial character and interpreting the result thereof. So, this is the definition given by Committee on Terminology, which was set up by AICPA. So, what are they saying here? They're saying that you are going to find out transactions and events which have a financial character. If not completely financial transaction, at least a part of it should have some financial character. Those transactions you are going to record, classify, then summarize and interpret the result. So how are we going to do this? You're going to record it in a journal, which is also called subsidiary books or primary books. Then you're going to classify those transactions and events in ledger, which is also called secondary books. You're going to classify them as income, expense, assets, and liabilities. Then finally, you're going to summarize them in your financial statements, which is nothing but your profit and loss account and balance sheet. In terms of money, you're going to do all of this in terms of money. It means measuring at the ruling currency of a country. Suppose your business is in India, then you're going to record all of this in INR. If your business is in America, then you're going to record all of this in US dollars. Likewise, whichever country you are dealing with, the currency of that country is what you have to record, classify, summarize, interpret. All of that should happen. That is, your accounting should happen in the ruling currency of that country. So here, as per this definition, accounting is nothing but simply an art of record keeping. That's all it says. In today's world, there is a lot of diversification of management and ownership, globalization of business, and society is gaining more interest in functioning of the enterprise. Therefore, just record keeping is not enough. You have to communicate the result, like what happened in this business. You have to communicate the result to user of your financials. This has become more important. Communicating has become more important. So, we are taking another definition. In 1966, American Accounting Association gave a definition which goes as follows. The process of. So what we have to note here is, in 1961 definition, accounting is an art. In 1966, they are saying it's a process. So what is the process? The process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by the users of accounts. So here you take economic information. That economic information, first you identify it, then you measure it, and then you communicate it so that the users will be able to form informed decisions. This is what the 1966 definition is saying. Here, economic information is nothing but the same. Transactions and events which have financial character is called your economic information. So that information, first you identify which is relevant, which is not relevant. You identify it, then you measure it, and then finally you communicate it to the users. So who are the users of accounts? First, internal users. They are nothing but the board of directors, partners, managers, officers. That is, people who are directly related, like who are working in the organization. They are the internal users. Next, external users. They are nothing but investors, lenders, suppliers, government agencies, customers. That is, people who are not related, not working inside your organization. They are your external users. So, transactions and events. Everywhere we are talking about transactions and events which have to be recorded. So, what is exactly transactions and events? Transaction is nothing but a business, performance of an act, and agreement. So, here something that you do is a transaction. Whatever you're doing is a transaction, and the result of what you do is an event. So event is nothing but a happening as a consequence of transaction, a result. So what you do is a transaction. The result of what you did is an event. here. So let's see the procedure of accounting. Procedure of accounting is nothing but first you generate financial information. How do you generate financial information? First you record it, then you classify it, and then you summarize it. That recorded information you are going to use. How do you use it? By analyzing, interpreting, and then communicating. So first you generate financial information. That generated financial information you're going to use. So what is the step? What are the process? You first record it, classify it, summarize it, analyze it, interpret it, and then finally you communicate it. So how do you we're just going to see the process. Okay, so what do you give input? Economic events, so events and transactions which have financial character, those economic event you're going to input. Then it goes through an accounting cycle, which is nothing but you record it in your journal, post it in your ledger, prepare a trial balance, then prepare final accounts, your balance sheet, P&L, and finally that output you're going to communicate to the users. Users are nothing but internal users and external users we already saw. This is your procedure of accounting. Thus, accounting may be classified as the process of recording, classifying, summarizing, analyzing, and interpreting the financial transactions and communicating the result thereof to the persons interested in such financial information. So first you record, classify, summarize, analyze, interpret, and then you also communicate the results. Next, we are talking about economic events and transactions measured in financial terms. Let's try to understand that better. Let's say I am running a stationery shop. My investment is rupees 2 lakhs, and on 1st January I purchase stock worth 1,15,000. In the month of January my sales is 1,47,000. For January I have paid 5,000 rupees rent and my closing stock is 15,000 rupees. Now I want to know whether my business has been in a profitable situation or a loss. Let's find out. I made a sale of 1,47,000, which is my income. I am adding stock in hand 15,000. So 1,62,000 is what I have in my hand right now. Then I am deducting purchases 1,15,000, rent 5,000. So finally I have made a profit of 42,000. Here this purchase, sales, rent paid are all transactions which was done by me. As a result of this transaction, I have a closing stock of 15,000 and a profit of 42,000. So what I do is a transaction. Result of what I did is an event, like we already saw. Okay. Next, aim of accounting. What is the aim of accounting? To meet information needs of decision makers. For decision makers, they need input based on which they can make decisions. That is met by accounting. Hence, accounting is called language of business. Next, let's get into the details of procedure of accounting. Like we already saw, first what we do is we record. Recording is the very basic function of accounting. It is done in a book called journal. So all business transactions that we record should have a supporting document. If not, it cannot be recorded. Let's say I'm going to say that I made a sale. Then I should have an invoice that supports the fact that I made a sale. If I say I made a purchase, there should be a purchase invoice. If I say I paid rent 5,000 rupees, then there should be a rent receipt. Likewise, every transaction that I record should have a supporting document. Only then those transactions can be recorded, and recording is done in a chronological manner. Next, what we do is classify. This classification is nothing but whatever we recorded, we are going to analyze it in a systematic manner. We are going to analyze it in a systematic manner. Like how we are going to analyze it, we are going to group transactions of similar nature in a particular place. Okay. Where does this classification happen? In ledger. We classify transactions as income, expense, assets and liabilities. All these happen in the ledger. Like let's say rent, then there is a separate ledger for rent. Let's say salary, there's a separate ledger for salary. Similarly, separate ledger for sales, purchase, everything. So we summarize. Next what we do is we summarize data that is classified under financial statements. Preparation and presentation of classified data is nothing but summarizing. We summarize it so that it is useful for the users of financial statements. This process leads to preparation of financial statements. Basically, financial statement nothing but profit and loss account and your balance sheet. So after summarizing, what we do is we analyze. Methodical classification of data given in financial statements. So let's say in the financial statements, I have listed furniture and fittings rupees 1000, air conditioner rupees 2000, then land rupees 1 lakh. Likewise, I have made a listing. Okay. What we do in analysis part is we take these transactions and give it a heading called fixed assets. Then there is bank, cash, all that we take it under current assets. So similarly, we categorize each item in the financial statements and give it a heading so that it's easy for us to analyze. This is what we do in the analysis part. So it provides basis for interpretation. Once we have given a proper categorization, then it becomes easy for us to analyze. Next, we are going to interpret. Interpretation is nothing but it is a final function of accounting. Whatever we analyze, we are going to give a meaning and a significance of the relationship as established by analysis of accounting data. Whatever we analyzed, we are going to give an interpretation for it, so that it helps the users of the accounts to make a judgment and a decision based on what we have analyzed. So it is nothing but financial statement should explain not only what had happened, but it should also explain why it happened, what is likely to happen under specified conditions. Okay, this is why we are going to do the interpretation part. We know what has happened by the financial statements. We have to explain why it happened and what can we expect to happen. That we do in the interpretation part, so that the users can form their own judgments based on this information. Next, final thing, communicating. Communication is nothing but transformation of this summarized, analyzed and interpreted data to users, so that users can make their own decisions. Okay, it is nothing but accounting reports. Let's say ratios, accounting ratios, how much is the net profit, how much is the gross profit, how much is the current ratio, and then you prepare graphs, diagrams, fund flow, cash flow, all of that. Actually, cash flow is a part of financial statements, but I'm just saying all of this is a part of communicating financial transactions that happened in a particular year to the users. But one thing here is, when you communicate, you also compare with previous years, and then you also give a forecast. When you prepare a graph, you say, okay, last 2 years my net profit was like this year it is like this, next year I'm expecting like this. So you communicate in such a way that it is very easy for the users to understand. Okay, so recording, classifying and preparing trial balance from this data is called bookkeeping. Okay, summarizing, analyzing, interpreting and communicating are all accounting stages. Using the financial information. Who is going to use financial information? Internal users, external users. We already saw who they are. The information, it has to be relevant and material to them. Otherwise, it is meaningless and useless to the users of financial information for their decision making purpose. And also, the information has to be free from bias. Then users should understand financial result from accounting figures. You have to prepare such that users are able to understand what you're trying to say. Okay, what they need to know is financial result. The way you communicate it to them, it has to be understandable, and it has to be reliable also, and it also has to be in such a way that they are able to compare your information with other opportunities and your past performance also. Okay, so when you communicate it to when you communicate information to your users, it has to be relevant, it has to be material, it has to be free from any bias, then it should be in such a way that they are able to understand it, and then they are able to rely on that information, and finally they are able to compare it with your past and future. Okay. Uses of financial information. First, investor. Why do investors need to know about your financial data? Because they have to take a decision whether they can invest in your business or whether they can hold the investment or rather sell it. They have to be able to take a decision. For this, they need to know about your financial data. And also the ability of your business to survive, prosper, and how much dividend you're paying, all that. Based on that only they can take a decision how your business is performing. Next is employees. Why your employees need to know? Because if you are growing, only then your employees' career will grow. Otherwise their growth also will be affected. So they need to know about the growth of your business, your stability, your continuity. Based on this only they can take a decision whether it's advisable to continue in your business, continue in your company, or to switch over. And how much remuneration you're providing, what are the retirement benefits also they need to know. Next, lenders. Lenders should know whether you will be able to repay the loan with interest. Suppliers and creditors, they need to know whether you will be able to repay the bills within the due dates, and also if whether your business is going to continue and whether the relationship will continue or not. And suppose, let's say you are preparing a raw material. Okay, you're preparing something which is going to be a raw material for another business. Okay, so only if your business is stable and continuing, the other business will consider making a purchase from you. If you are not going to be established and if you're not going to have a stable business, their business will get affected because they are taking raw material from you. So for all of these reasons, suppliers and creditors also need to know. Customers, similarly only, they need to know stability and profitability of your enterprise. So let's say I'm going to purchase a moisturizer. Okay, I'm purchasing a moisturizer from you. My body, my skin has got accustomed to your moisturizer. I'm really liking your product. I'm purchasing it from you. Suddenly one fine day you close your business and go. In that case, I'm not a person who changes my products. Okay, I am a person who uses what my skin is comfortable with. So suddenly if you shut down your business, then now I don't have a moisturizer. Okay, I have to find a new company, new product, right? So for all these reasons, customers also need to know your stability and profitability. Government and the agency. Government needs to regulate your business. They need to know whether if you are in a competing business, whether you allocate scarce resources, whether your business is controlling prices, whether you're paying taxes properly. Public needs to know whether you are making any substantial contribution to the local economy. Management to make management decisions. Objective of accounting. First objective is systematic recording of transactions. Basic objective of accounting is to record the transaction systematically. Okay, where do you record it? In journal. This journal will lead to trial balance, but the first thing that you do is you record in journal. This is the very basic objective. After recording, that data gets classified and summarized in the next steps. But the first thing that you do is you record your transactions, then you classify it in your ledger, then you summarize it so that you can prepare financial statements. So bookkeeping is the first step. We already saw bookkeeping is nothing but your recording, classifying plus trial balance is nothing but bookkeeping. So bookkeeping is the first part. After bookkeeping is done, you find out the result by preparing profit and loss statement. Based on your result, you prepare your financial statement. You now know whether your business is in profit and loss. Now you need to know whether your business is healthy or not. That you find out by preparing balance sheet. Finally, you communicate all of these matter by preparing financial reports to the users. So accounting as a language of business communicates financial result of an enterprise to various stakeholders by means of financial statement. Okay. Next, finally, to know solvency position. By preparing balance sheet, management will not only reveal what is owned and owed by the enterprise. Meaning, when you prepare a balance sheet, you also tell users what are your assets and what are your liabilities. But you also have to tell them whether you have liquidity or not. That is, whether you will be able to repay your loans with your assets or not, and what is your solvency position. All of this also you have to communicate to the users. So what are your objectives of accounting? First is bookkeeping. Second is finding whether you are in a profit or loss situation. Third is finding the health of your business by preparing balance sheet. Fourth is communicating all of this by preparing financial reports. And then finally, to know whether you have solvency position or not. Function of accounting. In 1970, Accounting Principles Board of AICPA says that function of accounting is to provide quantitative information, primarily of financial nature, about economic entities that is needed to be useful in making decisions. They are saying that it is to provide quantitative information, meaning you are able to measure something. Functions of accounting, the first function is measurement. You measure what is your present situation and your past situation. Okay, what is your present situation and what was your past situation? You measure it. Then you forecast what you expect for your future. Based on this, you make decisions. As an user, you make decisions. You compare this. Okay, you compare whether you are able to achieve your targets, whatever you forecasted, whether you are able to achieve it. You compare it. Then you disclose your accounting policies and your contingent liabilities. Then you control. You find out what are the weaknesses in your operation system. Then you provide measures to solve it. Okay, you find out what weakness you have in your operation system, then how to fix it. Finally, government regulation and taxes. So accounting provides information to government so that they are able to control your business and also collect taxes from you. These are the functions of accounting. Subfields of accounting. What are the subfields? Financial accounting, management accounting, cost accounting, social responsibility accounting, human resource accounting, and there are so many. We are just going to see the first 5. Okay, financial accounting. We already know what is financial accounting. Preparation and interpretation of financial statements is what we do in financial accounting. Mostly the data used here is of historical nature, what already happened. That is what we are dealing with in financial accounting. Then the result of it we communicate it to the users. In management accounting, whatever we do in financial accounting, we group those data in different way. Then we prepare reports so that it helps in easy decision making. So management accounting, it helps to discharge the functions of planning, control, decision making needs of the management. Next is cost accounting. Cost accounting is nothing but it is a component of management accounting. It deals with cost. If you are into manufacturing business, how much should the product cost be? Whether if we buy from this person at this rate, whether we will be able to reach our expected profit or not. So all those things you figure out by cost accounting. Social responsibility accounting. Demand for social responsibility actually stems from increasing social awareness. Today there is more social awareness. So if we are in a business, we should be more socially aware about what we are doing to our environment. So all of that comes under social responsibility accounting. Okay, so today I'm going to start a business in a new village. Okay, in a rural area. If I'm going to start a business in a rural area, I have to see whether I will be able to provide more employment opportunities to the local people, because I'm going to use their land, their resources, their space. Likewise, so all of this is covered under social responsibility accounting. Human resource accounting. Human resource accounting is an attempt to identify, quantify and report investments made in human resource of an organization. So I'm going to employ people, I'm going to give them training, and certain people alone I'm going to pick and give them better exposure, better opportunities. So all of these is covered under human resource accounting. So these are some subfields of accounting, not all. Okay. Limitations of accounting. In accounting, we only take into consideration what we can measure with money, but there are many items that we cannot measure with money, like employees' loyalty. Okay, these are all very valuable assets to the business, but since we cannot measure it with money, we're not considering it as an asset in our books. So whatever we can measure with money, only that we take into consideration. Balance sheet, it will show a position as on a particular date. When we write balance sheet, we write balance sheet as at 31/3/2022-23 likewise. So balance sheet shows position of a business as on a particular date, but users are actually more interested to know what happens in the future, in the long run, in next few years, what is going to happen to a business. That will not be reflected in the balance sheet. Then accounting ignores changes in some money factors, meaning like if you have inflation, deflation, all that is not considered in accounting. There are many occasions when accounting principles conflict with each other. Okay, this also we're not considering. Let's say relevance and reliability as an example. What is relevant may not be reliable, but we have to take a call. Okay, which transaction we can consider as relevant, which transaction can be reliable. Always what you can rely will not be relevant, what is relevant will not be reliable. So sometimes like there will be such conflicts, and at that time we have to like based on our own judgment we have to take a call. So mostly accounting estimates depend on personal judgment of accountant. Let's say another example, bad debts. Okay, there is nothing fixed that okay, next year this person will not pay me 10%. Nothing fixed is that. But I myself as an accountant, based on my relationship with that debtor, I decide okay, I will give a provision for bad debt as 10% this year. Okay, so accounting estimates depend on personal judgment of accountant. Finally, financial statements will consider only those assets which can be expressed in money. Human resource is also a very important asset, but since it cannot be expressed in money, we are not taking it into our books. Finally, different accounting policies for treatment of same items exist. Okay, but we have to take a decision which accounting policy to choose. That is also taken by the accountant. Role of accountant in the society. Only few professions in the world are held in high esteem. One such profession is the accounting profession. It is called fairest invention of human mind. Accounting profession is like an instrument of socio-economic change and welfare of the society. So in this profession, we can also bring into consideration socio-economic change and welfare to the society. It is all in the hands of the accountant. So the areas in which an accountant has the role is not limited. It is very, very vast and extensive. So let's just look into some areas. Maintenance of books of accounts, statutory audit, internal audit, taxation, management, accounting and consultancy service, financial advice, other service. So first, maintenance of books of accounts. Here an accountant maintains a systematic recording of financial transactions to fulfill twin objectives. What are the twin objectives? To find out what is the profit or loss situation and what is the health of the business. How do you do that? By preparing P&L and balance sheet. So this is what you do in maintenance of books of accounts. This is what we saw all along. So proper maintenance of books of accounts assists the management in planning, decision making and controlling functions. Next is statutory audit. For certain companies, statutory audit is mandatory. Statutory audit means they should have a chartered accountant audit their business. So for some business it is mandatory, for some it is recommendatory. Internal audit. Some business will have an internal auditor. That is, they'll have an auditor in their own team. This person, he will audit everyday transactions of the business, and if there is a problem, he will fix it immediately. If there is a leakage of revenue, misappropriation of assets or anything, it can be found out very easily, quickly and immediately by the auditor, internal auditor. So you don't have to wait for the year end for a statutory auditor to come and find out your flaws. You will have an internal audit team who will do all of that on a day-to-day basis, and the finalized data will be submitted to the statutory auditor. So nowadays internal auditing has developed as a service to management. Next is taxation. Accountant is the person who can handle the taxation part of a business, and he can also represent the business before tax authorities. He will also have all the data to prepare taxes. So accountants have a social obligation to express their views on broad tax policies, on the effect of tax rate and business on the economy in general. So since they are dealing with taxes, they also have a social obligation to express their views and opinion on the same. Next is management accounting and consultancy services. It is an advisory function. Management accounting and consultancy services is an advisory function. Here, internal reporting to management. He advises to the management. Management accounting is nothing but you help the management to make decisions by giving your advice to them. So accountant provides this advice, this consultancy in areas of MIS, expenditure control, evaluation of appraisal techniques for new investment and divestments, etc. It is not limited. Okay. Next is financial advice. Here the accountant gives financial advice in area of investment, insurance, business expansion, pension scheme, investigations. Investigations here means like why do we need investigations? What is the need for financial investigations? To find out the financial position of a business, to decide whether we have to manufacture something or whether we have to buy something, to find out why my profits have fallen, to achieve greater efficiency in management, to find out for fraud, if any, that has occurred. So for all of these, accountant is a person who can give better advice to value business and shares. Okay. Next, other services. Other services is nothing but secretarial work, share registration work, company formation, receivership, liquidations, arbitrations. As regards the cost accountant, like the cost accountant's job is to continuously report cost data and related information at frequent intervals to management. This is done by the accountant. Then accountant in information services. So these are the other services provided by an accountant. Now, what is the role of chartered accountant? Chartered accountant in industry. Generally, what happens is accountant, he is a part of the planning team, highest planning team. Accountant is a part of the planning team, but he is not the planner in industry. If there is a team, he is the part of it and he is in the top position. But when it comes to industry, he is not a planner. He works with the functioning department so that he can help the chartered accountant to be the planner, to take decisions, to perform his roles. So an accountant in an industry helps the chartered accountant. Next is in public sector enterprises. In a public sector enterprise, both in developing and developed countries, public sector enterprise has become a special feature in national economy. The form of accounting followed by these corporations is different from that of ordinary. Okay, we know this. Okay, what the financial statement that you prepare for a normal business is not the same as that of public sector enterprise. All this can be done only by a chartered accountant. It is his duty. Okay, not every accountant can do that. Only a qualified chartered accountant can do it. Next is in framing fiscal policies. Because a chartered accountant has wide knowledge about trade, commerce and industry, he plays a very important role in determining a proper fiscal policy for the industry and also for his own business. Business can be successful only if accounting and business knowledge are pulled together. So it is a social obligation. We already saw this. It is social obligation for both accountant in industry and also in practice to disclose greater information regarding corporate results. You have to disclose everything. You cannot hold back information to save your client or protect your client, because you have an impact on whatever you provide. It has an impact on the industry, on the entire industry. Okay, and that also helps in policy making. So you cannot hold back to protect a client or protect your own interest. Next, in economic growth, like we already discussed right now, in the present times, accountants should conceive their duties as broadly as the conditions might require and do not restrict them to only literally compliance of law. So only compliance of law is enough. Like that, you cannot say, okay, if a law is asking me to do item 1, 2, 3, I have done that, and that's it, my work is over. You cannot be like that. As a chartered accountant, you have to go overboard and see whether there are anything else related, similar and related to your business that you have to comply, that the business has to comply and that you have to audit. We already saw what is bookkeeping. Recording, classifying plus trial balance is bookkeeping. So bookkeeping is nothing but an activity concerned with recording, financial data in a significant and orderly manner, then classifying that data and preparing trial balance. Only till this stage it is bookkeeping. End of bookkeeping, what happens? We go to prepare financial statements. So end product of bookkeeping is financial statements. Accounting is based on a careful and efficient bookkeeping system. Only if the bookkeeping is correct, the output the next step, preparation of financial statement, will be correct. What are the objects of bookkeeping? First, we have to record all the transactions. Complete recording of transactions is important. Second, these transactions that we record, it should help in finding the financial effect on the business. So ascertainment of financial effect of the recorded transaction is the second objective. What is the difference between bookkeeping and accounting? In bookkeeping, we just record the transactions, whereas in accounting, we also summarize the transactions. Bookkeeping is the base for accounting, whereas accounting is the language of business. Financial statements are not prepared in bookkeeping stage. The result of bookkeeping leads to preparation of financial statements. Just by bookkeeping, management cannot take any decisions, but accounting enables management to take decisions. There is no subfield for bookkeeping, but accounting has many subfields. We also saw some time back. Financial position cannot be found out by bookkeeping, but we can find the same by accounting. Now, what is the relationship of accounting and bookkeeping? So first it is bookkeeping. Bookkeeping leads to accounting. Accounting leads to accountancy. That's what we are studying and doing right now. So this is the relationship of accounting and bookkeeping. What is the relationship of accounting with other disciples? Okay. First, accounting and economics. So in economics, what we do, it is a science of rational decision making about scarce resources, use of scarce resources. Whereas accounting is a system which provides data to users to form their own opinion based on what we give them, what we communicate. Okay, so this is what we do in accounting, whereas in economics, we take decisions about use of scarce resources. Some non-accounting data are also relevant in decision making in accounting. So here, accounting overlaps economics in many ways. First, let's say economic theories influence development of decision making tools used in accounting. So capital and income, okay, these two concepts, economists have a different view, accountants have a different view. Accounting also provides base data for economic decision models. Non-overlapping zones of accounting are not negligible, that is also relevant. So development of systems of recording, classifying and summarizing transactions and events, harmonizing the system by uniform rules and communicating the data is essentially a non-overlapping area. So we are saying non-overlapping areas are not negligible. What are those non-overlapping areas? These are all the same, development of systems of recording, classifying, summarizing transactions and events, harmonizing the systems by uniform rules and communicating. All of these are non-overlapping areas. Okay. Next, accounting and statistics. In accounting, information is very precise and exact to the paisa, but in statistics, it is not like that. We take a population, then we take a sample from it, and then we say what has happened. But it's not like that in accounting. Every data is recorded to the paisa exactly. Okay. Generally, accounting is for a particular period, for a short term. Okay, for 1 year accounting, 2 years, 6 months accounting. Like that, accounting is generally for a short term, mostly 1 year. But statistics is not like that. We can take it for many years also. We can take statistics for 5 years, 6 years, 10 years also. Many accounting formula is based on statistics. Okay, so statistics helps in interpreting accounting data. Therefore, study and application of statistical method would add an extra edge to the accounting data. So if you're good in statistics, you will be very good in interpreting accounting data. Next, accounting and mathematics. We all know mathematics is very important. That is, you have to be very good in numbers to be an accountant. So knowledge of arithmetic and algebra is a prerequisite for accounting computations and measurements. Some examples are calculation of interest, depreciation, hire purchase installment, repayment installment, finding out how much loan you have to pay, and for that how much money you have to set aside, lease, rent. Accounting data also presented in a ratio form. So for all of these you need to be good in mathematics. Double entry system can be converted in algebraic form also. In fact, the first known book on this subject was part of a treatise on algebra. So nowadays, because of computer, mathematics has become a very important part of accounting. Instead of writing accounts in traditional manner, the transactions and events can be recorded in matrix form, and rules of matrix algebra can be applied for classifying and summarizing the data. Okay. Next, accounting and law. Economic entity is created, controlled and operated by law. Every country has their own law, economic, physical, labor laws. Every country has their own laws. Very often accounting system has to be followed only by following those laws. Not very often, it is always okay. You have to follow laws of the countries where you're running the business. Next, accounting and management. Management is a broad occupational field. Accountants are placed in the management also, and they play key roles in the management also. Large portion of accounting information is prepared for decision making by the management. Evolution of accounting as a social science. How accounting became a social science. In olden days, what happened? Rich, wealthy people, they had some people called stewards to manage their property. Stewards are nothing but today's accountants. Okay, something like today's accountants. They are called stewards. So these people managed properties of wealthy men. They ran accounts in a periodical manner during their stewardship, that is during their employment period. They prepared accounts in a periodical manner, and this was called stewardship accounting, and it is the root of financial accounting. But then public limited companies came, large scale business came. So joint stock company and divorce of ownership and management led to the idea of financial accounting. Next, management needed to take decisions. So for this reason, management accounting evolved. From here, we also became socially aware. So at this point, social responsibility accounting also came. It is a formative process. The aim is to account for social cost incurred by the business and also social benefit attained by the business. Okay, so when we make profit, we are going to use land, minerals, material. We are going to pollute that place. All of this we are doing to earn profit. So what we are doing is social cost. Because of doing this, what we earn is social benefit. To compensate for this social cost, in today's world, a business is expected to generate some social benefit also, like providing employment opportunity to the local people there, creating recreation activities, more choice to customers at reasonable price, better quality products, etc. Okay, so because we are incurring social costs, we are also responsible to generate some social benefit to the environment and to the people around our business. Okay, the usefulness of accounting to society as a whole is the fundamental criterion to create it as a social science. Yeah. So that's it. We have seen Unit 1, meaning and scope of accounting of Chapter 1 today. Next video we'll go to Unit 2.